Welcome back, everyone, to part 2 of the Week 1 live chat series here in Finance 4324, Commercial Bank Management. In this session, we're going to explore the practical side of banking, the products and services many consumers already use, like deposits and loans, as well as the Federal Reserve, the central bank that shapes how money flows throughout our economy. By the end, you'll not only understand how these pieces work, but you'll also be able to spot them in action in everyday life. All banking starts with deposits. Deposits are divided into two categories: transaction deposits and non-transaction deposits. Transaction deposits include checking accounts where money moves quickly in and back out. Non-transaction deposits are savings accounts designed to encourage customers to hold money instead of spend it. Both are essential because they provide banks with the funds they need to make loans. Deposit accounts come in different flavors. Demand deposit accounts, or DDAs, do not pay interest, but they do allow for immediate withdrawals. Interest-bearing options include NOW accounts and money market deposit accounts, both of which came from regulatory changes in the 1980s. These products were designed to give consumers more flexibility while still keeping funds accessible. Beyond checking and savings, banks also offer longer-term deposits. Think of certificates of deposit, or CDs, where you lock up your money for a set period of time in exchange for a higher rate. Retirement savings options like IRAs and Roth IRAs also fall into this category. These deposits help banks plan their funding while giving customers a reward for committing their money over time. Deposits are only part of the story. A healthy economy also needs ways to move money around. This is where payment systems come in. These systems handle everything from paying for groceries, to businesses paying suppliers, to governments collecting taxes. Banks incur real costs to operate them, which is why we often see fees attached to payments. Traditionally, payments were made with cash or checks. Cash is still legal tender and works almost anywhere. Checks became popular as a convenient substitute for carrying cash, but they introduced complexity, like making sure the writer actually had the funds available to cover the check. A check is also referred to as a negotiable instrument, essentially a piece of paper that represents money. The rules are set by the Uniform Commercial Code, ensuring all parties understand their rights and responsibilities. Checks are less common now, but they paved the way for other modern payment systems. In the modern era, we've moved on to electronic alternatives. Debit and credit cards, stored value cards like gift cards, and even digital currencies such as Bitcoin and other forms of cryptocurrency. These new tools are faster and more convenient, but they also raise questions about security, privacy, and the role of banks in keeping payments safe. The check clearing process. When someone writes a check, it doesn't magically move money right away. Traditionally, checks went through a manual clearing process. First, they were bundled and sent to a processing center. There, high-speed sorters read the routing and transit numbers on the checks in order to direct them to the appropriate banks. Today, most of this happens electronically, with images of checks captured and transmitted almost instantly. Physical checks are still bundled into what's called a cash letter and then submitted to a clearing agent, but availability now often happens much faster, usually the same day or perhaps the next day. Loans. At the heart of every bank's business model are loans. Loans transform deposits into income for the bank. For customers, loans represent opportunities, whether that's buying a home, starting a business, or paying for education. For banks, loans are assets, much like accounts receivable on a company's books. Why do borrowers seek loans? For cash flow, capital expenditures, timing opportunities, and staying in business, to name a few. Think of a loan as oxygen for businesses and households. Without it, many could not survive, or at least not comfortably so. There are two broad categories of loans, commercial and consumer. Commercial loans cover business purposes, construction projects, and real estate. Consumer loans serve individuals, including mortgages, personal installment loans, and credit cards. Commercial loan facilities include lines of credit, term loans, mortgages, construction loans, and bridge loans. If you have ever seen a crane on the skyline, chances are that project is financed with a construction loan, which will later roll into a mortgage. Consumer loans. From the bank's perspective, consumer loans are often riskier. They're more sensitive to the economy, and they rely heavily on income levels and financial stability. These loans can range from short-term personal loans to long-term residential mortgages. Credit cards are especially profitable for banks. They're unsecured, carry higher interest rates, and they also earn fee income from merchants. Every time someone swipes a credit card, the bank is earning revenue. Banks serve more than individual consumers. They also provide treasury services to businesses as well as governments. These include lockbox services, ACH transfers, merchant services, and more. If you've ever received a paycheck electronically, you have been a direct part of a bank's cash management system. Banks also wear another hat, that of the trusted advisor. Wealth management services include investment advice, retirement planning, estate planning, and tax planning. In many ways, banks try to position themselves as lifelong financial partners. Trust services go one step further. Here, banks act as fiduciaries, managing assets for beneficiaries such as family members, charities, or estates. In these instances, the bank is legally required to act in the beneficiary's best interest, making this one of the most important roles that banks can play. Now let's shift our discussion to the Federal Reserve, the central bank of the United States. The Federal Reserve, or Fed for short, is independent from politics in most respects, yet its influence is enormous. The Fed's role is to monitor the economy and use various policy tools to promote stability as well as growth. The Fed is organized with a board of governors in Washington, D.C., along with 12 regional reserve banks across the country. This structure balances national policy with local insights from different parts of the economy. The Fed's goals are simple to state, yet tough to achieve. Keep inflation low, maintain high employment, moderate the business cycles, and support long-term growth. Achieving all of these at once is challenging, and sometimes the goals come into conflict. The Fed has three major functions: conducting monetary policy, supervising banks, and providing financial services to the banking system. Think of the Fed as both a regulator and also as a service provider. Monetary policy means managing the money supply and interest rates. The main tools are open market operations, the discount rate, and reserve requirements. These tools allow the Fed to tighten or loosen credit as a way to influence the overall economy. Among these, open market operations are the most powerful tools. By buying or selling Treasury securities, the Fed directly changes the money supply and thus influences interest rates. This action drives the federal funds rate, which then impacts loans and deposits throughout the entire economy. The Federal Open Market Committee, or FOMC, is where decisions get made. 12 voting members, including governors and reserve bank presidents, all meet regularly to set monetary policy. Whenever you hear news about the Fed raising or lowering interest rates, this is the FOMC in action. The Fed also provides emergency funding through the discount window, acting as a lender of last resort. Banks that cannot borrow anywhere else may turn to the Fed, though doing so often represents an indication of financial stress for that bank. Reserve requirements are another tool in the Fed's toolbox. By adjusting the percentage of deposits that banks must keep on hand rather than lending out, the Fed can directly affect how much money is available for lending overall. This tool is used sparingly because of its powerful effects. It is much more of a financial hammer and less of an economic scalpel. Putting it all together, you can see how the Fed's policies ripple throughout the economy. From the rates on consumer credit cards to the cost of a mortgage, the Fed's decisions affect households, businesses, and governments alike. You may wish to pause the playback and study this table briefly before continuing. We have covered a lot of territory in this session: deposits, payments, loans, cash and wealth services, and of course, the Federal Reserve. These are the cornerstones of modern banking. Remember, every time you swipe a credit card, deposit a check, or read a headline about the Fed, you're seeing all of these concepts in action. Stay curious, keep asking questions, and continue exploring, because understanding money and banking makes you both more credible as a professional, and it also gives you power over your own financial future. As always, reach out if you have questions about the course or about finances in general. I'll see you online.